The Signal in the Noise: What 40 Books on Investing Taught Me About the Architecture of Wealth. 1. The Information Overload Trap. Building wealth shouldn't feel like a mystery, yet for many, it feels like a drowning exercise. We are bombarded with a relentless stream of conflicting strategies, complex jargon, and get-rich-quick promises that prioritize volume over value. To find the true signal in this noise, I undertook a deep dive into 40 of the most influential books on finance. From the foundational classics of the 1940s to the modern behavioral manifestos of today. What I discovered is that true wealth is not built on complexity, but on a few remarkably simple, human-centric pillars. 2. Behavior Trumps Math: The Psychology of Success. In The Psychology of Money, Morgan Housel presents a truth that most analytical investors ignore. Financial success is not a technical skill, it is a soft skill. You do not need to be a mathematical prodigy to build a fortune. You need to master your own temperament. Wealth is dictated by your behavior, your patience, and your emotional control in the face of volatility. We often overlook time as the most critical variable in the wealth equation. Compounding is not a linear process. It is an exponential one that only reveals its power to those disciplined enough to leave it alone. To be a successful architect of your future, you must recognize that time is your greatest asset, provided you have the stomach to stay the course. How you behave with money matters more than how much you actually know about it. 3. The Great Clarification: Assets versus Liabilities. Robert Kiyosaki's Rich Dad Poor Dad offers the fundamental blueprint for distinguishing between the appearance of wealth and the reality of it. The poor dad mindset is trapped in a cycle of immediate gratification, frequently acquiring liabilities, such as expensive cars and luxury items, that drain capital through debt and maintenance. To build lasting prosperity, you must pivot your focus toward acquiring assets. Assets. These are your employees. They work for you while you sleep, putting money into your pocket in the form of businesses, stocks, or real estate. Liabilities. These are your masters. They take money out of your pocket, often fueled by the desire to project a status you haven't yet earned. Wealth is built by systematically trading the fleeting high of luxury items for the long-term freedom of income-producing assets. 4. Why Boring is Better: The Power of Index Funds. The combined insights of J.L. Collins' Simple Path to Wealth and John C. Bogle, The Little Book of Common Sense Investing, reveal that the most effective strategy is often the least exciting: living below your means and funneling the surplus into low-cost index funds. Many beginners fall victim to the Dunning-Kruger effect, a cognitive bias where a little knowledge leads to dangerous overconfidence. This manifests as the shortcut mentality, the belief that you can outsmart the market through active trading. In reality, this pursuit of shortcuts usually leads to higher fees and lower returns. The architect knows that the market is a machine, designed to reward those who stay consistent and minimize costs. They were bearish when they should have been bullish, and bullish when they should have been bearish, so the index at least steers a steady course. John C. Bogle. 5. Finding Your Margin of Safety. For the investor seeking a more active role, Benjamin Graham and Joel Greenblatt provide the framework of value investing. This is the discipline of viewing a business through its 5, 10, or 20-year horizon, rather than its daily ticker price. It requires calculating what a business is actually worth, its intrinsic value, and having the patience to wait until it is on sale. The margin of safety is more than a mathematical calculation. It is your emotional buffer against market volatility. It is the discipline to ignore the noise of businesses you do not understand, and the restraint to only act when the odds are overwhelmingly in your favor. Figure out what it's worth, pay a lot less, leave a large margin of safety between those two. Big space between those two things. Joel Greenblatt. 6. The Unexpected Catalyst: Mindset and Value Exchange. Perhaps the most profound realization from this research came not from a spreadsheet, but from The Secret by Rhonda Byrne. While many dismiss the law of attraction as spiritual fluff, its practical application is a cornerstone of the architect's mindset. To build significant wealth, you must first accept that money is a human construct, a fiction we created to facilitate the exchange of value. When you stop viewing money as a scarce resource and start seeing it as your creation, the mechanics change. By focusing on joy, love, empathy, and compassion, you improve the quality of your value exchange with the world. When your primary focus is on making a difference and providing genuine value to others, money ceases to be the goal and becomes the inevitable byproduct of your contribution. 7. Your blueprint for wealth. True wealth is a dual construction, a wealth of wallet supported by a wealth of mind. After distilling thousands of pages of financial wisdom, the blueprint remains clear. Cultivate a mindset of growth. Use visualization and positivity to stay focused on your vision. Live sustainably. Consistently spend less than you earn to create investment capital. Prioritize assets. Stop buying status symbols and start buying income-generating vehicles. Stay the course. Invest consistently in low-cost index funds and let time do the heavy lifting. Wealth is the result of the value you bring to the collective. Ask yourself, what is the true nature of my exchange of value today? And is my relationship with money built on a foundation of fear or a blueprint of contribution?